Imagine planting 5 trees today that, if watered and left alone, will grow into a small forest by the time you retire. No pruning, no constant babysitting, just patience and the right soil. In the next 20 minutes, I'll walk you through 5 ETFs that many investors use as those long-term trees, why they work, how they differ, and how you can use them in a simple buy and hold portfolio. Stick around. I'll also give practical allocation examples and the 2 biggest mistakes to avoid. Let's be honest, long-term investing is boring, and that's its superpower. You don't win by timing the market. You win by owning a broad slice of it, reinvesting dividends, and letting compounding do the heavy lifting. ETFs, exchange-traded funds, give you instant diversification, low costs, and the flexibility to set and forget or rebalance once or twice a year. In this video, we'll focus on 5 broadly useful ETFs: the broad US market, the S&P 500, total world equities, international equities, and a core bond ETF for stability. I'll name each ETF, explain what it holds, the role it plays in a portfolio, pros and cons, and a suggested allocation for different risk profiles. Here are the 5 ETFs we'll cover. 1. Vanguard Total Stock Market ETF, VTI, US Total Market Core. 2. Vanguard S&P 500 ETF, VO, Large Cap US Core. 3. Vanguard Total World Stock ETF, VT, Global Equities in 1 ticker. 4. iShares Core MSCI Total International Stock ETF, IXUS, XUS Equity Exposure. 5. Vanguard Total Bond Market ETF, BND, Broad Investment Grade Bond Exposure. Deep Dive, VTI, US Total Market name/ticker. Vanguard Total Stock Market ETF, VTI. What is a single ETF that owns thousands of US companies, big, mid, and small caps, representing nearly the entire investable US stock market. Role in portfolio, core growth engine. Because it covers the whole US market, it captures winners that aren't just the mega cap names. Over decades, the US market has delivered robust returns, and VTI is a low-cost way to ride that growth. Why people like it? Extremely low expense ratio, huge liquidity, and hands-off diversification across sectors. It's simple. Buy VTI and you own America's public companies. Downside, heavy US concentration. If the US underperforms the rest of the world, you'll feel it. Also, it is market cap weighted, so the biggest companies get the biggest weight, which can be good or bad, depending on the cycle. Script lines to read aloud. VTI is like owning the entire US stock market with 1 ticket. If a new company grows into the next Apple, VTI captures that success. Suggested use. For most US-based investors, VTI can be a 40 to 60% core equity position in an aggressive growth portfolio, or paired with bonds for a balanced portfolio. Deep Dive, VO S&P 500 Core name/ticker. Vanguard S&P 500 ETF, VO. What is? Tracks the S&P 500, the 500 largest US companies by market cap. Think Apple, Microsoft, Amazon, and the giants. Role in portfolio, lean, efficient exposure to large cap US stocks. Many investors prefer VOO for its simplicity and alignment with how many pension funds and institutions manage core equity exposure. Why people like it? Ultra-low fees and concentrated exposure to major companies that are often more stable and profitable than smaller peers. VOO tends to be less volatile than a total market fund during certain market sell-offs because of the larger, more stable companies it holds. Downside, less small cap exposure. Less diversification than a total market ETF like VTI. If mega caps fall, VOO can still be hit hard because it's dominated by the largest names. Script lines to read aloud. VOO is the blue chip backbone, the largest, most established American companies under 1 roof. If you want to own the economic engines of the US, VOO is a top candidate. Suggested use. VOO can replace or be paired with VTI. Many investors hold one or the other rather than both. Consider VOO for a slightly more conservative equity core. Deep Dive, VE, Total World Equity name/ticker. Vanguard Total World Stock ETF, VT. What it is, a single ETF that holds global equities, US and international developed and emerging markets together. It's basically by the world. Role in portfolio, instant global diversification in 1 ticket. If you don't want to think about US versus ex-US splits, VT is a neat solution. Why people like it: simplifies rebalancing and taxes. One fund owns nearly every public stock worldwide. It prevents overconcentration in a single market and naturally adjusts to global market cap weights. Downside: you still get heavy US weighting because the US is a large part of global market cap. Also, owning all markets means you'll own underperformers at times. But that's the point of diversification. Script lines to read aloud. VT is a one-ticket global portfolio. It's the lazy investor's dream when the goal is simple global exposure. Suggested use: great for investors who want a truly global equity base without juggling multiple funds. Deep dive: IXUS, International Equity Name / Ticker. iShares Core MSCI Total International Stock ETF, IXUS. What it is: broad international equity exposure excluding the US. It covers developed and emerging markets outside the United States with thousands of holdings. Role in portfolio: diversifier. Historically, international markets move differently than the US, and including IXUS helps reduce home country bias and smooth returns over the long run. Why people like it: low cost for broad ex-US exposure and an easy way to intentionally tilt toward international markets if you already own a lot of US equities. Downside: international equities can underperform US stocks for long stretches and may have different fee/tax considerations depending on your account. Currency swings and geopolitical risk are factors to watch. Script lines to read aloud. IXUS helps you own the rest of the world: Europe, Asia, emerging markets, so your portfolio isn't just a US story. Suggested use: add 10 to 30% of your equity allocation to IXUS if you want meaningful international diversification. Deep dive: BND, Core Bond Exposure Name / Ticker. Vanguard Total Bond Market ETF, BND. What it is: a broadly diversified bond fund holding US investment-grade bonds, treasuries, corporate bonds, and mortgage-backed securities. Role in portfolio: stability, income, and downside protection. Bonds tend to be less volatile than stocks and can dampen portfolio swings. BND is often used as the fixed income core in balanced portfolios. Why people like it: broad exposure, typically lower fees than active bond funds, and consistent income. BND is a go-to for investors who want a simple bond sleeve. Downside: interest rate risk. When rates rise, bond prices fall. BND holds a mix of maturities, so it's sensitive to rate moves. Also, bonds typically offer lower long-term returns than equities. Script lines to read aloud. Think of BND as the shock absorber. It won't win a race, but helps you stay in it when markets get ugly. Suggested use: for conservative investors, bonds can be 40 to 60% of the portfolio. For aggressive investors, 10 to 20% bonds can still smooth volatility. Portfolio examples: I'll give 3 simple templates you can adapt. 1. Aggressive growth, 20 to 40 years horizon. VTI or VOO, 60%. IXUS, 20%. VT, optionally replace VTI plus IXUS with VT at 80% if you prefer one ticker. BND, 20%. 2. Balanced, 15 to 25 years horizon. VTI/VOO, 40%. IXUS, 20%. VT, 0 to 10% as a consolidated global sleeve. BND, 40%. 3. Conservative, 10 years or less for retirees. VTI/VOO, 30%. IXUS, 10%. VT, 0 to 10% optional. BND, 60%. Rebalancing and taxes. Rebalance once or twice a year. Don't overtrade. Use tax-advantaged accounts, 401k, IRA, for taxable bonds or international fund with higher dividend distributions where it makes sense. If you're taxable, consider tax-efficient placement. Hold tax-inefficient assets, bonds, inside tax-deferred accounts, and equities in taxable/brokerage or Roth accounts, depending on your situation. Always check the taxable implications of dividends and foreign tax credits if you hold IXUS or VT in a taxable account. Biggest risks and mistakes: chasing hot performance. Past winners don't guarantee future returns. Overconcentration. A single megacap or sector can dominate if you only own a narrow ETF. Use broad funds to avoid blind spots. Ignoring costs and taxes. Expense ratios may be tiny, but over decades they compound. And taxes can erode returns if you don't use the right accounts. Final takeaways. For most long-term investors, a combination of broad U.S. exposure, VTI/VO, international exposure, IXUS or VT, and a core bond allocation, BND, builds a solid foundation. Choose the simplicity of VT if you want global coverage in one ticker. Choose VTI/VO plus IXUS if you prefer to control US versus ex-US weights. Keep costs low, rebalance occasionally. And remember, time of the market beats timing the market. If you found this helpful, like and subscribe for more simple, research-backed investing explainers. See you in the next video.